This conference will now be recorded.
Thank you for joining me. My name is Steve Tuttle, and I'm the Chief Investment Strategist and a partner at Signet Financial Management. I'm going to discuss our market outlook. Basically, we believe we're in for some more volatility in the near term, but there will be opportunities in the future. And I'm going to cover some of those highlights in our presentation now. So it's certainly been a volatile couple of weeks. But recently, the last 10 days or so especially, markets have been showing signs of stability, which is a very good thing. The S&P 500 has bounced from very deep oversold levels. That's indicated on the chart below. And at the same time, various measures of volatility or risk in the markets have been trending down as well. So when you combine these two together, it does suggest that the number one fear, which is basically a total collapse of the economy and stock market, we think this has been dismissed for the near term. Markets seem to be normalizing. As I said, volatility measures are declining, and markets are showing signs that it's going through a bottoming process. But we're not out of the woods yet. I think it's very important to emphasize some caution is still warranted. Be very careful about chasing stocks higher after this rally. And as always, patience and discipline are key to successful investment management. History tells us that markets go through a bottoming process, and it takes time generally. This is a slide from Goldman Sachs. It shows how the market behaved and bottomed in the financial crisis of 2008 and 2009. What it shows is that there were multiple periods of strong gains followed by more downturns. And essentially the market went through a period of large gyrations up and down. History doesn't always repeat exactly, but it's something to keep in mind that we may be in for some more volatility ahead as we go through this bottoming process. A lot of what the market is trying to react to is the unknown. Essentially, I think the trajectory of the spread of the coronavirus is going to determine exactly how and when the markets and the economy bottom. The second quarter is beginning with a number of concerns on the one hand and a number of potential positives on the other hand. The top two concerns and positives all relate to the spread of the virus. If the infection rates continue to expand and don't show signs of peaking, we could be in for some more extended pain. If, however, the spread of the virus peaks, and in the New York metro area where I'm from, it does show signs of peaking, perhaps this recovery could be for real, and we could be back to normal sooner than we anticipate. This could lead to a reopening schedule announced for the economy, the implementation or execution of some very strong central bank support and fiscal and stimulus policies that Congress enacted. And also a potential positive to the markets could be the end of the oil price war and a possible OPEC accord, which has actually been in the news just this week. So if there is one bright spot to any sell-off, it's that there is a correlation between market valuations and forward or expected earnings. And this is a slide from Research Affiliates. Essentially what it shows is that as the market sells off, this is on the blue side on the left, as the market sells off, the valuation of the market improves. And as the valuation of the market improves, the expected returns of the market looking out improve as well. And I just caution you that valuation work, which I'm a big believer in, is not very useful in helping determine where the markets will be in a month from now or a year from now or even 2 years from now. These correlations or these projections with valuations are much more useful over very long periods of time, like 7 years, 10 years, in that range. So if valuations are better, how do we participate? What makes sense now for investors? One area where we think is a nice compromise is to add to stocks in areas that have exhibited low volatility. And there's a family of lower volatility strategies that we're actually currently using with many clients that attempts to capture an attractive upside downside ratio. And that's what this slide shows right here. This is a chart from November of 2011, which is when this specific exchange traded fund from BlackRock came out. And what it shows is that when the market is going well, the market is going up, this fund captures most but not all of the returns of the market. And conversely, when the stock market is going down, is doing poorly, this type of strategy doesn't lose as much. So that's one way that we are rebalancing accounts currently. We're trying to use these low volatility strategies to increase our equity stake, but at the same time be aware and be a little bit more cautious about avoiding some of the downside. Another opportunity we see in markets is in municipal bonds, particularly high quality municipal bonds. This is a really informative chart from Goldman Sachs. Essentially, it shows periods of time where municipal bonds sold off, like they did in March, actually. And what it shows in 4 of these cases, going back in history, after that sell-off, municipal bonds generated strong returns if you look out 3 months, 6 months, 12 months, 24 months. And we think we're in a similar situation right now. So we think, particularly if you have taxable money, municipal bonds are a way of generating some attractive tax-free income right now. Sticking with the bond side, another area that presents potential opportunity is credit, corporate bonds. We believe that right now, particularly because the Fed has announced that it is going to support the corporate bond market and is actually going to be offering to purchase and provide liquidity to the corporate bond market, that adding some credit exposure into portfolios makes some sense. Whenever you do something like that, you do take on some equity risk. Credit is correlated with stocks. When stocks do well, credit does well, and vice versa. So to offset that, in our bond allocations, we not only have some credit exposure, but we have some very high quality U.S. government exposure. And the two form sort of a barbell where one helps support and complement the other. We think that's a good strategy in the markets right now. And the last potential opportunity that I'll mention is small caps. Small caps are a very well-known asset class, and there's a lot of academic research that shows over long periods of time they've been a very strong performer. However, if you look back over the last decade, that has not been the case. This chart on the left below is the performance of the small cap value index measured by the Russell 2000 value compared to the S&P 500. And as you can see, the small cap value has lagged quite a bit because it's far below where the S&P 500 is. The reason I show this is because coming out of periods of recession, small cap value has historically done very well. And the two most recent periods of time, the tech bubble in 2000, which lasted into 2002, and the financial crisis of 2008, 2009. In both cases, the small cap value indexes were very strong compared to the large cap indexes coming after recession. So that's also something that we're taking into consideration as we construct portfolios. So I'm going to end with a few final thoughts. One, be mindful of continued risks ahead. As I mentioned earlier, I don't think we're completely out of the woods yet. However, think about opportunities. Think about opportunities to enhance the returns in your portfolio. Historically, sell-offs create better valuations. Better valuations lead to higher returns out into the future. And the key is to be disciplined and patient, and that's what we pride ourselves here at Signet Financial from doing. So I want to end by telling you, please be safe. If you have any questions on your portfolio, please reach out to your financial advisor and have a good day. Thank you.